Hey everybody, my name is Doug Pardick. I'm a financial planner, certified retirement counselor with Talon Wealth Strategies. I'm teamed up with a group of independent financial advisors located here in Littleton, Colorado. Our mission is to strengthen families by helping you make excellent financial decisions. So here we are at the beginning of October 2019. We've had a lot going on in the market. I want to quickly give you an update and an outlook, and then maybe a solution to think about if you're looking at your financial plan and worrying about a possible recession. So let's get started. In 2019, we've had really good returns in the stock market. Yeah, there's been volatility, but that's normal. Having a 5% drop in the stock market, it's typical to have 3 to 4 of those per year. So here we are, S&P up 20% year to date. Foreign stocks up 13%. And this is through September 30th, 2019. US bonds up 8.5%. And a balanced portfolio, so 50% stocks, 50% bonds, up 11.26%. This is American Fund's conservative growth and income portfolio, just to give you an idea of what kind of returns are happening out there. Now, if we scan back, instead of just looking at 2019, let's go back 2 years. Because you guys remember, 2018 finished with a 20% drop in the stock market. And luckily, we had a V-shaped recovery. The stock market bounced back and was on a tear for the first four months of 2019. But unfortunately, if you look at where the S&P was back on January 26, 2018, we are right back to where we started 20 months ago. This is a sideways market, and this explains why when you're looking at your portfolio and you would think, man, I've not made much money since early 2018. Well, the stock market is pretty much where it was 20 months ago. So we've got a lot of headlines out there giving investors fear and caution, and business owners caution as well. The global slowdown, it is happening. We're seeing a lot of manufacturing slowing down across the globe, and that's also happening here in the United States. Right now we're at October 4th, and we've gotten some data from U.S. manufacturing that it's slowing down, and that's sent some jitters into the market, and we had a pretty good sell-off. Today the market's rebounded a little bit, but you know, the market is going to be panicky and emotional in the short term and very inefficient. So it's a tough thing to watch on a daily basis, but headlines add risk to the markets. So as a financial advisor and planner for clients' money, we don't just look at one single factor when looking at the economy and where we see things going. Yes, the yield curve inverted, and that is it's a pretty good indicator that the recession may be coming in the next 12 to 24 months. But that's not the only thing we look at. We look at monetary policy. The Fed, are they raising rates? Are they lowering rates? And right now they're lowering rates. So that's actually a good thing to keep this economic expansion going. Housing looks to be doing pretty well as interest rates have come down. And the trade war with China, now that's one of the big things that we're watching. And we're watching the U.S. consumer, and we're watching U.S. businesses to see how they react with this environment that's going on. So the trade war with China, I've been on a conference call the last 2 weekends with Dr. Ken Kim. He's an economist located in China. And from what he says, China is sweating this war more than we realize, more than the media is telling us. And the Chinese media is definitely not going to be letting on that the Chinese are sweating this. But from what he sees living there, they are sweating this. And they can't wait till the 2020 election to resolve this trade war. So he thinks it's going to be resolved sooner, maybe by the end of this year or early next year. And if this does get resolved, this is going to be a nice tailwind for the U.S. economy and the global economy. So stay tuned, but we'll see if Dr. Ken Kim is right about this, if his hunch is right that this trade war may be coming to an end sooner than we think. U.S. manufacturing, I've mentioned this, businesses are just not spending right now. They're not hiring. We're not seeing layoffs quite yet, but that could be the tipping point if they begin to lay off because they just don't see clarity in this environment and there's just too much uncertainty. This could lead to a recession sooner rather than later. So let's hope for this trade war to be resolved with China. So if the recession is going to be coming soon, and it may be in 2021 or sometime beyond that, nobody knows for sure. We're watching the indicators, but right now it's still a lot of uncertainty. And there's a better bet that the recession is going to be delayed, but man, it's a close one. So it's better to prepare now and not predict what's going to happen when it's going to happen. So here's some strategies that people use. They can go to cash and time the market. Hey, let's get out. Let's wait till the market goes down quite a bit and get in near the bottom. This is a very hard thing to do, and I think you know this, but timing the market, going to cash is an expensive thing. Studies will show that your long-term returns are much lower when you try to use this strategy. You could use insurance in your portfolio. That's putting protection on the downside, limiting your downside participation. When the market goes down, you won't get hurt as much, but you're also going to be limited on the upside. So it's an option. It's worth looking at, and we do have strategies like that you can use for part of your portfolio. Another strategy is using an asset allocation models. I see a lot of financial planners out there using this, but I think it's a C or C minus type of strategy. We think you could be smarter with your money than just having an asset allocation and holding to it. So a strategy that I often use with my clients who are near retirement or in retirement is the bucket approach. And I'll give you a really quick example of how this works. So we take your portfolio for your investments that you're going to be needing over the course of your lifetime. We put some of it in bucket 1. This is going to be very ultra low risk. It's going to cover your expenses for years 1, 2, and 3. And then you take some more money and put it into bucket 2 strategy. This is lower risk, but we're investing in things to allow us to just keep up with inflation and maybe surpass inflation, but we really don't want to chase risk and chase yield. And this is to cover your expenses in years 4 through 8. So then the rest of your money, this is long-term investment money. So in 2028 or 2029, this is when you would finally tap into this portfolio because it's 8 years away and you can take on more risk. And you can invest in the stock market or things that have really good appreciation over time, but may be more volatile. Here's another way to look at it. So bucket 2 is feeding bucket 1. Bucket 3, when the markets go up and we have really good solid returns and it's a good time to sell high, you sell high and you replenish bucket 2 and replenish bucket 1. Bucket 3 is, I do not believe in just putting it into an asset allocation model based on your risk tolerance. Yes, if your risk tolerance says you're a 75% stock, 25% bond, yeah, that's where we'll start. But if we have a good economic run, we want to let winners run. And so let that portfolio get from 75 to 80 to 83%. And then we see that, hey, the run has had a really good time. We've got good gains. Let's rebalance them. But let's not just stay in that 75-25 portfolio because that's what it is, a 75-25. Let the winners run. And then when the market's starting to get some indicators that the market may have bad times coming up, which we're seeing now, get defensive. And that's what we've been doing in our portfolios for bucket 3. We've been selling high, selling out of growth, and rotating into value. We've rotated into some gold, and that's been a really good play for the last 4 or 5 months. And we are going into more defensive types of stocks and bonds. High quality, good cash flow, we're being defensive. And then when we get into the cycle when it's time to start buying low on the growth and opportunistic stuff, we'll do that. We can never time it perfectly. Nobody can, but we want a portfolio that's smarter than just writing a pure asset allocation model. So to learn more about how we manage money and how we take care of our clients, feel free to give me a call, or if there's anything going on with your own financial plan or you're worried about the recession, you're worried that you don't have a really good bear market strategy to anticipate what's going to be coming around the corner, give us a call. We'd love to meet with you. We have free consultations. Our number is 303-951-5987. Have a great day, and hopefully we'll see you soon.